Good morning, everyone, and welcome to the EMJX Fireside Chat. My name is Valter Pinto, Managing Director at KCSA Strategic Communications, and I'm joined today by a very special guest, Mr. Eric Jackson, founder and CEO of EMJX. I'm really looking forward to our discussion this morning with Eric. Before we begin, I'd like to remind everyone that statements made today may be deemed forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. Actual results may differ materially from those expressed or implied due to risks and uncertainties described in the company's filings with the SEC, including its periodic reports and investor materials. EMJX and SRX Health undertake no obligation to update forward-looking statements except as required by law. We'll start today's fireside chat with a brief presentation by Eric, followed by opening the floor to the live Q&A. For investors who have not yet submitted questions, please send them through the Q&A chat at any time. We'll do our best to get to everyone's questions this morning. If for any reason we do not get to your question, please email us at emjx@kcsa.com. As a reminder for everyone, in December 2025, SRX Health entered into a definitive agreement to acquire EMJX, a next-generation digital asset treasury platform that applies quantitative models, AI, and systematic risk controls to multi-asset digital treasury management. While the transaction has not yet closed, which will limit how much we can talk specifically about the combination of the two companies, the closing is expected to occur during this first quarter of 2026, subject to approval by SRX Health shareholders and other customary closing conditions. Once closed, the company will operate as EMJX and be led by Eric as CEO. Please note this call is being recorded today, Thursday, January 22nd at 11 a.m. Eastern. A replay will be available on the SRX Health Investor Relations website following the conclusion of today's discussion. Before we hand the call over to Mr. Eric Jackson and give him a warm welcome, here's a short video brought to you by EMJX.
In every era, there's a moment when the rules change. Most people don't see it. They feel it. Too late. Inflation. Geopolitics. AI. Digital assets. The old portfolio wasn't built for this battlefield, so a new command center was built. EMJX is a professionally managed digital asset treasury designed to navigate volatility, not fear it. Multi-asset, AI-driven, risk-managed. Built by Eric Jackson, the investor who spotted platform inflections early. Before Carvana, before Open Door, before the crowd woke up. This isn't about chasing coins, it's about controlling the terrain. One structure. One strategy. One decision. Choose your side before the map is redrawn.
Today is really an opportunity to share in more detail with the many people that have expressed interest in EMJX, what we're focused on, what our company is all about, and why we think it's uniquely positioned in the space. And on this first page here, the title page, I have about 15 minutes to go through these slides with you this morning. This last sentence on the title page kind of really is the key here. There has been a lot of misinformation or misunderstanding about what EMJX is. And we are definitely not a company that just holds crypto. We are much more than that. We think of ourselves as a Generation 2 treasury operating system. And if nothing else, I want to explain to you over the next 15 minutes on why that is so and why that's an important distinction. So next slide, Valter. I don't want to name any companies in particular. I've got enormous respect for everybody who's out there building companies. It's difficult to do. But I did want to say that I think there's some important distinctions that should be made between what Generation 1 treasuries have been doing up until this point and what we're trying to do differently in building EMJX to be a Generation 2 treasury operating system. With Generation 1 treasuries, it's important to remember that most of them have chosen willingly to be kind of single asset. They want to be measured as just passive balance sheets onto themselves. They don't really have a strategy articulated for dealing with volatility, which is obviously something that's inherent in the crypto markets. And there's no kind of talk about or discussion about adaptive risk routing. Typically, if asked about volatility, a lot of the folks running Gen 1 treasuries ask you to, as an investor, just take a step back, think about this in a 15-year time period, and just ride out the short-term volatility. That's often something that's a difficult pill to swallow for a lot of investors, and it doesn't really address the larger market out there, which is anyone who has a treasury of any kind, which is something that we're more interested in. But I think the last point here is probably the most important for me, which is that a lot of times, and we've seen this definitely in the last 3-4 months, where there's been this drawdown in crypto. Drawdowns create stress, obviously, inherently. And stress creates a lot of forced decision making. And often that forced decision making is, when you look back on it, what ends up killing you as an investor or in running a treasury itself. And so what EMJX has built itself to be over the last 4 or 5 years is a system that is built kind of to withstand different regimes, different environments, including high stress environments like the ones we've seen the last few months, and to always have a kind of governance approach, a rules-based approach that never lets anyone operating that treasury using our software to feel stressed or forced into kind of some bad decision making, but take that kind of longer term view. So that's what's different about us. Next slide, Valter. So what we are, as opposed to a Generation 1 approach, is we're a treasury operating system. We're not a fund. We're not a crypto fund. We're not a hedge fund. We're building something to last. And the reason why that distinction is important is that we have spent a lot of time on governance, on rules. We're not YOLOing into different trades. We're running a system that is sort of built on intelligence. It's aware of different market environments. And at the end of the day, it allows somebody who manages that treasury using our software to feel like they're built for survivability, not speed. Because anybody who has a treasury it's probably a more complex and more volatile treasury today as a result of the introduction of crypto to it. It used to be, in the old days, everybody just had cash, fiat cash, and treasuries, if they were trying to be complex. But in the world of crypto, it's 24/7, markets never close. There's inherent volatility, even in the granddaddy assets like Bitcoin and Ethereum. So anybody who has a treasury that is building in crypto and then in future tokenization of real world assets, they have to have a risk system that is helping them manage that volatility. That's what we do. Next slide. So we will have our own treasury. We do have our own treasury, but the point of our own treasury is to really show our models, our governance layer, and our sort of how we manage through different regimes in action. It's sort of dog fooding the AI models and machine learning models that we've built in real life. But we aren't just interested in having the best performing treasury through different market environments. The real market that we're building EMJX for is really not just all the Gen 1 treasuries that are out there, although they are potential partners and people that would be interested in using our own risk management treasury operating system to better create yield for themselves with the crypto assets that they manage. But we're really it's a much bigger market that we're going after. We're interested in the market for anyone who has a treasury, and that could be Citibank. It could be any type of bank. It could be a company like Verizon. There are a ton of pension funds, institutional investors. Everybody has a treasury today. As I said before, though, that they've typically been very simple treasuries consisting of just fiat cash, and if they're complex, maybe treasuries. But they are now facing, more continuous volatility with the introduction of crypto assets to those treasuries. And so as a result, the legacy treasury tools that were built decades ago for that older, more stable 9:30 to 4, and then we close trading hours until tomorrow type of environment, that those types of legacy tools don't work in a world that trades 24/7, in a world that is introducing things like tokenization of real world assets. And so what we are doing is we are building a governance, risk routing, perception set of risk management tools so that anybody who manages that treasury, whether big or small, complex or rather simple, can just better manage that risk and do so consciously with human rules that make sense, that are board approved by their board of directors, just in the way that they are used to in the old world. And we don't think that the legacy treasury tools that exist today are going to be able to be extended to kind of operate properly in that more volatile crypto environment. So that's what we've spent the last 4 to 5 years building. We exist to make treasuries function properly, not just to hold assets. And as a result, the way that we're going to be measured is through the value that we create as our infrastructure starts to extend out to all of these treasuries. We won't be measured by the size of our own treasury. Next slide. So how do we do this? There's like 3 main components. The one that typically captures most people's interest is the sort of the QAM models, or the quantitative allocation method models. So these are AI models, machine learning models that we obviously use to hedge the risk. So the important thing about these models, it's important to distinguish what they are and what they are not. What they are really effective risk routing systems. They show how much exposure is at risk in a treasury at any time. They are stress tested across regimes. So it's not enough just to have a model that works in the good times. We've obviously seen how that works for most of the Gen 1 treasuries. Would be just fine if it was up and to the right all the time. But as we know, in these last, basically since October 10th, you cannot build your system just to operate in the good times. You have to be able to survive during the down times as well. So our models have to be similarly stress tested across all different types of market regimes. Otherwise, they're not useful. And the models are always designed to reduce forced decisions, like I said before, because forced decisions are typically bad decisions. But what these models are not, though, is they're not alpha creating tools. They're not allowing every corporate treasury to become a hedge fund. Corporate treasuries do not want to become hedge funds. They want to be secure and safe. So these are not models for trading. These are not models that are typically focused on return maximization. We want to capture the upside convexity that exists inherently in crypto, which we are bullish about, and which we do believe that Bitcoin and Ethereum are going to appreciate materially over the next 15 years. And anyone who has a corporate treasury is going to capture some of that upside. We will capture that too, but we're not focused on 3xing whatever Bitcoin does during the good times, the way some of the Gen 1 treasuries have. And obviously during the down periods, That kind of focus on profit maximization can get you in trouble and can lead to the bigger drawdowns, which has plagued so many of the Gen 1 treasuries. Next slide. One thing that you might have captured or seen on the earlier slide or kind of on the website is that in addition to just building our own treasury that we have predominantly with Bitcoin and Ethereum, because those are the granddaddy crypto assets. Those are the ones that are going to continue to be used as collateral by many, many clients as we move forward in the next 15 years. We also have a convexity sleeve. And that gets people excited because there is big potential upside in these names. So I wanted to carefully explain, though, what it is again and what it isn't. The reason why we have this convexity sleeve, it's a mixture of both coins and equities. And we made an announcement last Friday that we added in the real life treasury that is now trading our first convexity equity position, which was open door. So the reason why we have this sleeve is that we believe every treasury does need a carefully considered, capped, governance-ruled sleeve that presents potential upside to the treasury. And that doesn't mean you just pick a random set of equities or altcoins to put into the sleeve. We put careful thought into the types of coins and the types of equities that fit our criteria, which we believe have a high degree of convexity. And we cap this sleeve at 10% cost of the total value of the treasury. In the backtesting that we've done, we've found that our ability to properly select the types of coins or equities that go into the sleeve can have a materially positive beneficial effect on the overall treasury. Just a pure hedging system without this sleeve just simply doesn't perform as well over time and over different market environments. So it gives our treasury more optionality. We think that it's going to do the same for our clients' treasuries as well. But it's, again, capped at 10% at cost. So it's not going to hurt the overall treasury if these positions underperform or do nothing for a period of years. But it will materially help performance if a handful of them do well, as we expect them to do. But how they get in the mix is completely rules bound, and they always operate subordinate to the operating system. There is never a time where there's a trader within EMJX saying, hey, we're going to go heavy on this additional equity, because somebody it's hot on X these days and so forth. There's careful thought that goes into it. And we think it's going to be a material benefit to our treasury and our clients' treasuries. Next slide. The other areas, though, once you get past just talking about the AI and ML models, and we're certainly proud of the work that we've put into those models, there's a whole additional layer which we think makes our models better. And it has to do with basically how we perceive what's going on out there in the world. So if you wanted an analogy, think about full self-driving for a company like Tesla. Tesla obviously spends a lot of time on the AI, ML models. But if Tesla didn't have any sensors on the cars, the models are kind of meaningless. And so are the sensors something purely off the shelf that you're getting that everybody else shares? There's a lot of potential sources of information that we can use to build our models that anybody building financial models or crypto models can pull off. And some of them are pretty, generic, like technical indicators, volume indicators, things like that. But we've been spending a lot of time, and we are going to have more to say in the coming weeks about our own proprietary, internally developed developed sensors, which are we think give our models a significant advantage. So what are we measuring? What you will soon see are we're getting at signals of early stress and narrative divergence, which have to do with perceptions, market perceptions. Now, somebody, I had a conversation earlier this morning, and someone said, "Oh, well, isn't that just sentiment index? Can I measure that already?" Yeah, there are lots of off-the-shelf sentiment indices that you could build a model on. And trust me, we've done the experimentation. We've tried to build models with them. We've found that the ones that we have internally developed and that we have a roadmap for continuing to extend are just a lot more interesting and a lot more fruitful. So we're particularly excited about it. So this measurement, these sensors, inform our own governance rules. They don't override the governance. We don't just sort of react to things that are changing out there in the market. We have a dominant way of looking at how we manage our treasury. But if we can get better signals of what's happening sooner, and I'll give you like one for instance, if we knew very soon after October 10th that Binance had a stablecoin mispricing that caused a bunch of forced deleveraging in the crypto market in the coming weeks, which then a month later bled over into the equity markets, we can make, we think, obviously, like better governance decisions about how we manage our own treasury through those kinds of environments. If you have a bunch of off-the-shelf sensors that don't pick up those kinds of nuances, then you are obviously going to miss them and only react to that a month later, once you see kind of further evidence of things changing out there. So better perception leads to better actions for the Treasury. Next slide. So we have better models, we have better sensors, and better, I guess the third leg of the stool is really better governance overall. We have better rules on top, overseeing how we manage our models, how we follow rules, and how we react to different changes of regimes. Obviously, one of the keys is knowing when you're moving from a benign market into a down market or about to move into an explosive upside market. You want to be positioned properly as those regimes change, just like you want to have a coat when it starts to become winter in New York, for example. So success for us looks like fewer decisions over time, better responsive models that react to the different regimes, boring discipline. Boring can be beautiful, actually, especially when you're dealing in a volatile market like crypto. Being boring during the last 3-4 months is very welcome to most clients. Most people don't just want to see huge 50% drawdowns over a month. We want to be known as a company at EMJX that preserves optionality across cycles. We're helping our clients' treasuries always capture the upside, but we're protecting them during the downside periods. And, I think if we were to come back and do a Zoom like this a year from now, and you said, Eric, what does success look like? It's that people think of EMJX as infrastructure, not as a balance sheet, which is what, a lot of new people do today. I think that's it.
Thanks, Eric. That was super helpful. Really appreciate taking us through the presentation and appreciate everybody's participation. We have a lot of questions that we'll try to go through the allocated time that we have. First question, and probably a good place to start, Eric, is for those that aren't familiar with your background, tell us a little bit about the background, your team. I'm sure you have a big R&D team that helps you with the development of the technology. Maybe that's a good place to start.
Sure. I got my PhD in management from Columbia Business School about 25 years ago here in New York. I was obviously, always interested in being research driven, but also interested in technology. I mean, and 25 years ago was the time of the dot-com era. You couldn't be at Columbia Business School without being swept up in sort of the excitement that was going on then. Started working, decided I didn't want to be an academic, and worked for a tech firm, pre-IPO, a tech firm right out of school for 4 years, where I kind of, nurtured the bug that I have for technology that's followed me for the whole career. But decided a few years later that I wanted to express that interest in technology by being an investor. And starting my own hedge fund. So I've gone through, worked at 3 different firms now. The last one, EMJ Capital, I started 10 years ago as sort of like a more fundamentally driven, bottoms up, growth focused, kind of small to mid cap focused tech hedge fund. And got the bug to work on AI and ML models starting in 2021. Initially, was sort of interested in using it for use in the hedge fund, and have built a bunch of models that I have successfully used in the hedge fund. Probably the kind of the most famous one is that a couple of years ago, one of the first iterations of the first AI models that we built helped us flag Carvana as a significant long to get into in May 2023, when Carvana was $11 a share. After it had been at $400, and then it went down to $3.50 in December of 2022 because people thought it was going to go bankrupt, and now it's sort of come all the way back. So now it's I think $460 as of today. So when our AI model flagged it in May of 23 at 11, it was still a very controversial stock. And yet, what was interesting to me is that the model didn't care. If I'd been surrounded by a bunch of 20-something MBAs at a Monday morning investment committee meeting, I'm sure very few of those MBAs would have had the confidence to recommend a name like Carvana at the time. It was very controversial. Yet the model didn't care. The model just wanted to kind of spit out what it thought was the best idea at that particular moment. And it happened to say it should be the second largest long position that you have in the portfolio as of today. I didn't quite trust it at first because it was the first iteration of our model. And I remember we took about a week to kind of further check that everything was right with the calculations that we'd done. By that time, Carvana had gone up to $15 a share, but we did get into it. It did prove to be, obviously a very strong investment, and gave us a lot of insights into the kinds of early stages of public equities that have a potentially very, very significant upside. But as we were doing that, we were also building crypto models, and we learned that the crypto models were actually better performing models than what we were seeing with any of our equity models. And that, when I say more successful, they had higher hit rates, they had higher mean returns per trade. And I think that the reason why was because we just had simply more interesting information to use to build the crypto models. So we had things like, obviously, all kinds of information about the wallet level transactions that go on in crypto. We had stablecoin information, money moving in and out of stablecoins and onto various blockchains. It wasn't just simply kind of the simple technical price information or fundamental price information that you would have for equities. So that's where the idea sort of came about how can we better leverage these models beyond just for making a profitable trade within a hedge fund. And this was when obviously MicroStrategy was very popular, and then inspiring a bunch of copycat kind of Me Too Gen 1 treasuries. And I didn't really see the differentiation between any of them, but it did make me start to think about, hey, wouldn't it be more interesting to try to think about using these models to build a more robust risk management system? Because that's potentially a much more exciting market. You're talking about anybody who has a treasury anywhere is going to need help as like if you think of the percentage of the wallet share of a typical treasury, it's going to move from 100% fiat to in the future, I don't know, whatever it's going to be, 10%, 20%, 40% crypto, and then the rest fiat. And so that's going to present a bunch of volatility and angst and anxiety. And I sort of looked around at the kinds of tools that have existed in the past and how they sort of fall short in this new dynamic world. And that's how we came to get excited about putting these models into EMJX and launching this. So it doesn't really scare me at all that some people say, isn't this the worst time in the world to launch a treasury company? Well, yeah, if we were launching a Gen 1 treasury company, I would agree with you, but we're not. This is like Google coming along in 2001, 2002 in the middle of a bear market in .com and saying, yeah, no, it's actually a great time as long as you've got a really solid product that's, significantly better than anything that has existed previously. And that's what we aspire to with EMJX.
Yeah, and to that point, I think, Eric, you articulated it well at the onset of your presentation, the difference between Gen 1 and Gen 2. Just curious, and some in our audience are asking, and maybe you can't get into specifics, obviously, but it seems natural that other treasury companies will actively want to speak to you to have you manage their portfolio. It seems natural that, as you deploy and have those conversations, seems natural that they would use your risk management platform. Is that an accurate statement?
Yeah, we've had conversations like that already. I mean, there are people that are around today that some have $1 billion worth of Bitcoin on their balance sheet. Other people might have a lot of Ethereum. Other people might have a lot of XRP or Solana or what have you. And everyone's a little different. But for example, like in the case of the people that have all this Bitcoin on their balance sheet, they're not generating any yield from that Bitcoin. That's one problem. And then secondly, when you have periods like the last 3-4 months, they get penalized as public companies for having that Bitcoin exposure. It helps them during the up times, hurts them during the down times. So to have a system that can help them hedge during the down times and better protect themselves, as well as generating a consistent yield. It doesn't even have to be a hedge fund, alpha, triple digit, shoot the lights out number, just a boring, predictable, even single digit annual yield. I mean, higher is always better, but that gets them very excited, especially like if they're holding something like $1 billion of Bitcoin. So yeah, we've had those kinds of conversations. We think that what we've built is pretty thoughtful, and it's definitely led to like some interesting early discussions. And so that's really what we're going to be focused on this year is obviously successfully launching our own treasury, number one, but secondly, looking to kind of have a handful of what I call mandates over the course of this year, where we get clients like that, like you talk about, Valter, where we can implement our models and risk management system for them on a select portion of the assets that they have, and hopefully show them over time that this really works, and then seek to grow that. And then longer term, phase 3, as I said, is really the growth focus is on anybody who has a treasury. We want to allow our software and risk management to kind of be easily used by anybody who has a treasury, who's looking to increase the percent of their wallet share towards crypto over time.
Yeah, and in your presentation, you did speak about the recent purchase of Open Door. I guess the algorithm and the platform is not limited to just crypto. It's where you can get the most yield for your shareholders. But where's the healthy mix between crypto and equities in your mind? Or is it really dependent on the technology telling you what that is at any given time?
You mean from this convexity sleeve that I talked about? Yeah. What we've found is that like there's sometimes a very big difference, a very low correlation between various coins and Bitcoin and Ethereum, and then various equities and in Bitcoin and Ethereum. We found a blend of both equities and coins. And it's a very specific set of criteria that we use to kind of decide which should be in each category. It's not just, again, YOLOing into a bunch of like random meme coins or altcoins, but very kind of thoughtful exercise. We found a blend seems to perform best. And has a lower correlation with Bitcoin and Ethereum overall than if it was just only coins, convexity coins, or only convexity equities. But then there's a bunch of other rules that we follow as well, because obviously, you want to be pay attention to liquidity concerns. Is a coin liquid enough, or an equity liquid enough to be part of a significant treasury? You want to be sure that you're capturing the asymmetric upside. So, what is which coin? There are a lot of coins out there, but which ones truly have the opportunity to potentially 100x over the next, 5 years? You can find lots of great projects in crypto. For example, Zcash, is a very interesting particular project for privacy. Sort of has a unique attributes. But it's a little big right now, frankly, to consider for the convexity sleeve. Anyway, there's a lot of careful thought that goes into who should be in what. In the case of Open Door, it met a bunch of criteria. Even though it's 10x in the last, whatever it's been, 7 months, it still has enormous upside. It's sort of like the best opportunity out there to sort of capture the automation of the real estate market over the next 5 to 10 years. It's in the sweet spot from a macro perspective, where we're expecting falling rates to come in the coming quarters. So that made it particularly attractive to kind of be the first named equity to that sleeve. But there will be others.
Interesting. And as we wrap up, Eric, I really appreciate your time today. Getting a lot of questions about catalysts. So again, the transaction has not closed, so we're limited in what we can say. But how should investors look at the rest of the year? What are catalysts and things that investors should be looking forward to hearing from us in the coming months and the rest of the year?
Well, as you said, like the deal has to close. We have previously guided when we did the December 16th announcement that we expected it to close Q1. Nothing's changed in that respect, and we're still expecting that. It could be sooner, it could be later. It sort of depends on a bunch of things that are outside of our control. We have to kind of follow the rules as we're given them by the SEC, but we're still very confident in that. I think once the catalyst closes, obviously, there's going to be filings and disclosures. I get questions all the time on X about share count and things like that. I'm not the CEO until the deal closes. Once the deal closes, the name will change. I'll become the CEO. But everything is going to get shared, obviously, in the filings, and we'll do that in a timely way. Someone was asking me, like, is a share of SRXH going to equal, a share of EMJX? And yes, that is what's going to happen. Like once the deal closes, the ticker will change, but it won't happen until then. So watch for the closing, obviously. And then I think you're going to be wanting to watch how we perform once I'm fully in control of the business. You're going to want to pay attention to how our own treasury performs. How much cash do we have in that treasury? How has it performed over different regime environments? We will report, as we go, so that people can do that. And then you're going to want to see whether other people choose to kind of want to work with us and give us mandates where they take portions of the crypto assets that they might have on their balance sheets already and want to experiment with seeing how our risk management framework does and kind of creating additional yield and protecting the downside on some of that for them. So that's what we're really focused on in 2026, is sort of having more proof points by the end of the year of the durability of the models that we've built, the durability of the sensors that are proprietary to us and that we've launched and share. We're going to have the sort of first public set of our sensors launched in early February. So you're going to want to pay some attention to that. I think it's going to be pretty interesting, pretty unique. It's not a Pauline market. It's not a Kalshi. It's something that we've developed ourselves that's completely unique and built for our purposes of better assessing and managing risk. So you're going to want to pay attention to that. And if we do our jobs, and if I do my job, we'll be able to show that we've created value on the upside. We've captured like the convexity of the crypto market, but we've done a much better job than the Gen 1 treasuries at protecting the downside as well.
Well, I really appreciate it, Eric. We're just about over the allocated time for today's Fireside Chat. I do want to thank, obviously, Eric and everybody that has participated. We had a really great audience. We didn't get to everybody's question, but if you have any questions, please email us at emjx@kcsa.com. This is not the last Fireside Chat that we'll do together, hopefully. And as a reminder, the recording will be posted on our website at the conclusion of this call. Eric, really appreciate the discussion. Have a great time in New York City, and we'll talk soon. Thank you, everyone.
Thank you.